What if the money in your bank account suddenly vanished, not because of a thief, but because of a mathematical equation that went horribly wrong? On September 15th, 2008, the world woke up to a reality that felt like a nightmare. Lehman Brothers, a 158-year-old financial titan that had survived world wars and the Great Depression, collapsed in a single day. This wasn't just a bank failing. It was the heart of the global economy stopping mid-beat. In the weeks that followed, nearly $10 trillion in global household wealth evaporated. Millions of people who had spent their entire lives working for a quiet retirement saw their dreams turn into digital dust. We often hear about the housing bubble or Wall Street greed. But those phrases are just the surface of a much darker, much more complex machinery. To truly understand the 2008 crisis, you have to look past the suit and tie press, conferences, and into the shadows of a system that was designed to fail from the very beginning. This is the story of how the world's most powerful people gambled with money they didn't have, on houses people couldn't afford, creating a house of cards that nearly brought civilization to its knees. The seeds of the catastrophe were planted years earlier in a period of deceptive calm. In the early 2000s, the American dream was being sold on an assembly line. The engine of this dream was the mortgage. Historically, getting a loan to buy a house was a rigorous, almost sacred process. You needed a high credit score, a stable job, and a significant down payment. Banks were careful because they held on to those loans. If you failed to pay, the bank lost money. But then, the rules of gravity changed. Wall Street discovered a way to turn boring home loans into high-speed financial rockets. They called it securitization. Instead of holding your mortgage for 30 years, the bank would sell it to a massive investment firm. That firm would take thousands of mortgages, from the reliable ones to the incredibly risky ones, and bundle them together like a giant financial burrito. They called these mortgage-backed securities. On paper, it looked like genius. By mixing a few bad loans with many good ones, they convinced the world that the risk had simply disappeared. But the hunger for these bundles grew faster than the supply of honest homeowners. This is where the story takes a predatory turn. To keep the machine running, lenders began lowering their standards. They created subprime mortgages. These were loans given to people with no assets, no income, and no jobs, often called NINJA loans. Why would a bank do this? Because they weren't the ones at risk anymore. They would flip the loan to Wall Street, collect their fee, and walk away. This created a perverse incentive. The worse the loan, the more of them you could churn out. Millions of families were lured into homes with teaser rates, low payments for the first 2 years that would later skyrocket to impossible amounts. The housing market wasn't just growing. It was inflating like a giant fragile balloon. People were using their homes like ATM machines, taking out second mortgages to buy cars and vacations, convinced that house prices would never, ever go down. It was a mass delusion fueled by cheap credit and the arrogance of a financial elite that believed they had finally outsmarted history. As the bundles of mortgages moved up the financial food chain, they were sliced and diced into even more complex products called CDOs, or collateralized debt obligations. Imagine a skyscraper where the bottom floors are made of rotting wood, but the penthouse is built of steel. Wall Street told investors that even if the bottom floors rotted away, the penthouse would stay standing. Rating agencies, the supposed referees of the financial world, were paid by the banks themselves to give these piles of junk a triple E rating, the same safety rating given to government bonds. It was a massive conflict of interest, masquerading as mathematical certainty. But there was one more layer to this madness: credit default swaps. These were essentially insurance policies on the mortgage bundles. Companies like AIG sold billions of dollars in this insurance, betting that the housing market would never fail. The problem was, AIG didn't actually have the cash to pay out if those bets went south. The entire global economy was now a giant web of bets piled on top of bets, all resting on the ability of a waiter in Las Vegas or a construction worker in Florida to pay a mortgage they could never truly afford. Then, the first card fell. In 2006, house prices stopped rising. As those teaser rates expired, monthly payments for millions of people doubled or tripled. Foreclosure signs began to pop up like weeds across the American suburbs. Suddenly, those AAA bundles weren't worth their weight in paper. The steel penthouse was actually resting on the rotting wood, and the whole skyscraper began to lean. On Wall Street, panic set in. Banks stopped lending to each other because nobody knew who was holding the most toxic assets. It was a digital heart attack. When Lehman Brothers was allowed to fail, the message to the world was clear: nobody is safe. The crisis jumped from the housing market to the stock market, and then to the real world. Suddenly, companies couldn't get the short-term loans they needed to pay their employees. The gears of global trade ground to a halt. In a desperate attempt to prevent a total dark age, governments stepped in with the bailout. Trillions of taxpayer dollars were funneled into the very banks that caused the crisis. The justification was that they were too big to fail. If they went down, they would take the entire world with them. The hidden angle of 2008 isn't just the money that was lost, but the trust that was shattered. While millions lost their homes and their jobs, the executives who engineered the collapse walked away with multi-million-dollar bonuses. Not a single high-ranking Wall Street executive went to jail for the fraud that nearly destroyed the world. This created a deep, festering sense of injustice that changed the course of history. It gave birth to movements like Occupy Wall Street and the Tea Party. It led to the rise of populism across the globe. Perhaps most importantly, it inspired the creation of Bitcoin, the first attempt to create a financial system that didn't rely on central banks or too-big-to-fail institutions. The 2008 crisis wasn't just a financial event. It was a cultural and political earthquake whose aftershocks are still being felt today. We are still living in the world that 2008 built, a world of massive wealth inequality, soaring government debt, and a fundamental skepticism of the experts who claim to have everything under control. Why does this matter today? Because the ghosts of 2008 have never truly been exorcised. To save the system, central banks didn't fix the underlying problems. They simply flooded the world with even more cheap money. We traded a housing bubble for an everything bubble. Today, global debt is at levels that would have been unthinkable in 2008. The too-big-to-fail banks are now even bigger and more powerful than they were before the crash. The complexity of our financial products has only increased, moving into the realms of high-frequency trading and algorithmic shadows. We are told that the system is safer, that the regulations are tighter, and that we have learned our lesson. But history shows that the hubris of the financial world is a recurring theme. The names of the assets might change, the technology might evolve, but the human impulse to chase infinite growth on a finite planet remains the same. We are still walking on a tightrope, and the wind is starting to pick up. As we look back at the wreckage of 2008, we have to ask ourselves a chilling question. Was that crisis a one-time accident, or was it a dress rehearsal for something much larger? We live in a system that requires constant growth to survive, but that growth is increasingly fueled by debt rather than productivity. We have built a global civilization on the belief that we can borrow from the future to pay for the present. But eventually, the future arrives and it demands to be paid. The 2008 financial crisis showed us how fragile our solid world truly is. It showed us that the people in charge often have no idea what they are doing until it gets too late. The next time the system starts to shake, there may not be enough money in the world to buy another exit. In the end, the most dangerous thing about the 2008 crisis is what happened it. That's the fact that we think it can't happen again. The house of cards is still standing, and we are all still living inside it.